Let's bring in Rich Weiss, CIO over multi-asset strategies at American Century, and Jim Tierney, CIO of U.S. Concentrated Growth of AB. Jim, let me start with you. Are people being too cautious about risk, or are you getting more cautious?
I think people are being too cautious. You look at money flows, and tons of money is flowing into bond funds and out of equity funds, and that's been a trend for years and years. A lot of people have missed this rally. When I look at it, when I look at where equity prices are versus bond yields, equities still look pretty darn attractive to me.
A lot of the money that has flowed out of equity funds has flowed out of managed funds and into index funds. I assume that in a market that might be a little toppy, you, as an active manager, would say active funds might have some advantage.
Absolutely. Look at this week alone. Within FANG and Microsoft, you had Netflix really disappoint, and Microsoft hit it out of the park. Within the railroads, you had CSX disappoint. KSU had great numbers. So being selective, being active right now is really what you want to do, in our opinion.
Rich Weiss, what do you think? Are investors being too cautious, or is their caution well-founded?
Well-founded, no question. The stock market is clearly feeding off of interest rates. And even with a 25 basis point or even 50 basis point cut around the corner, valuations are still not compelling. It's the fundamentals that aren't there, and that's what the bond market, gold, and other markets are watching out for. I think this is prudent to be cautious, especially if you're near or in retirement and can't afford the downside. The market is very toppy. It's a little early in the earnings seasons, of course, right now, but earnings growth, marginal in the handful of companies that have reported so far. On average, negative surprises on the top line or revenue growth. So I think you really need to be cautious here. We're not selling stocks, but we're certainly not throwing money at the stock market right now.
Jim, speak directly to Rich.
You know what? I think that if you're selective, you can find some great growth companies right now. Abbott Labs reported earlier this week phenomenal growth and raised their organic growth for the year. Microsoft's numbers just off the charts. Even Charles Schwab, they haven't had an analyst call today, and their expectations of what's going to happen over the next few quarters well above where Street was expecting things to fall out.
So, Rich, do you quarrel with Jim's point of view that there are pockets of opportunity, particularly among those are large cap growth companies, or do you not quarrel with that and say, yeah, he's got a point there, but overall it's time to be cautious?
Overall, time to be cautious. Don't quarrel with Jim, though. We do have pockets or see pockets of opportunity, but I dare say we're on the other side. Not growth. Large growth has been the play over the past 10 years, but hey, that's like driving a car looking in the rear view mirror, okay? You're liable to go off the cliff with that one. Value stocks, which have been out of favor for quite some time, in particular the financial sector, equity income funds. This is where we're more safely positioned, and in particular in the U.S. We've been overweight U.S. vis-a-vis international for some time, and that's been a good, safe play.
I want to give you a quick final rejoinder there, because he said growth is rearview mirror stuff, Jim.
If we can find a portfolio, which we think we can, that can grow revenues high single digits, low teens earnings growth, that's attractive in any environment.
All right, gentlemen, we leave it there.